Cash. We're all familiar with it. We know it in its physical form and in our bank accounts, and maybe even in a cash ISA. We know its benefits, it pays interest, you can get hold of it when you want it, and it's low risk. But while we all use it and appreciate how easy it is to use, it suffers from one big drawback. We pay for that access in the form of lower interest rates. So low, in fact, they can be less than inflation. This is one of the characteristics of cash, which means some people don't want to invest in it. Cash is one of a number of different assets you can invest in. So what are the other types of assets known as asset classes, and what are their drawbacks and benefits? Property, with its rental income and the potential for its value to go up, will outperform cash a lot of the time. But in many ways, property's biggest drawback is that it's almost the opposite to cash. It is illiquid. It may be difficult to sell when you might need the money for something else. Also, there's greater risk in owning a single property than having your investment spread across several buildings. Equities, stocks and shares, are higher risk than cash and are much more liquid than property. With dividends and capital growth, they generally outperform cash, and you can still get your hands on your money when you need it by simply selling them. On the other hand, their value does fluctuate and can fall, so they may not be at the price you'd like them to be at if you have to sell at a particular time. A bond is a loan to a company or government, which pays a given rate of interest, which you know about at the start. Their value fluctuates in sympathy with the market, and according to how likely it is the issuer will be able to repay the loan. You wouldn't expect that loaning money to the American government would carry the same risk as the Italian government, and you'd be right. Unlike equities, access is more limited, but their value is less volatile. So, as you might expect, they are roughly between cash and equities in terms of risk. But beware, there are different kinds of bonds issued from different types of companies and governments from all around the world. So, cash, property, equities and bonds, and the fifth main asset class is commodities. You don't need to be a trader to know that commodities change price. If you have a car, you'll have a notion which way the price of crude oil is going. The values of coffee, sugar and steel are always changing. And predicting these changes when investing in commodities has high risks, with the potential for large losses or gains. Commodities, however, are liquid, and you can get hold of your money by simply selling at any time. So, to summarise, there are 5 main asset classes to consider, each with their own characteristics. If they were to be grouped on a chart from lower to higher risk, cash would be considered the least risk, then bonds, then commodities, then property, and finally equities on the higher risk side. However, there is a way to invest without having to research single equities or properties. It's much easier and less time-consuming to choose an investment fund that invests in either one asset class or multiple asset classes. With a fund, you're leaving the experts to decide which asset classes to invest in and manage how the fund is invested.